the cooperative business is where the action happens. And just as the leaves of a plant where photosynthesis happens, and it's a process we can barely even comprehend as with our current technology, and yet it still needs water. So it's not a question of, you know, what's more important, the business or the capital. It's a question of getting the resources that the business needs, just like water to a plant. And that's also partly why we like seeds. It is not because we just do seed capital. It is because the metaphor of a seed is very useful, we find, in thinking about capital in a business. And commons, because the capital, once it comes to seed commons, once we receive an investment, the deployment of it is controlled by a democratic process. Our credit committee is appointed through a cooperative structure of membership who appoint the credit committee. So that's why it's a commons. And their values that they pursue, solvency is one of them. Profit maximization is not. And again, we like the metaphors of life. You know, if you're bringing in less energy than you're expending, that's what's called dying. Life will die. And same with a business. You bring in less money than you spend, you will die. But life doesn't then say, so therefore we should bring in as much energy as possible. That's when you become overwhelmed, and, you know, that's like what a cancer does, and you will die too. So it's a life, you know, life shows a sense of balance about what it means to reach equilibrium, and that's what we seek in our businesses as well. So a couple of quick things on this. Let's see if I can scroll. Community Wealth Cooperative is our subname. I'll just mention that. So a couple of things. We have over 10 million invested. We're actually a $17 million fund right now. We plan to hit 20 million before the end of the year. It's over 100 loans we've made across the country. There are 25 members, so that is cooperative members. It doesn't mean like Costco members. It uses the word member in a real way. They're not all full members. There is a kind of lengthier process of becoming a full member than there might be in a worker cooperative. It could take a couple more years, but it depends on how fast certain milestones and trainings have been hit. It's actually up to about 30 members now. This is a map that shows you the different members. The Working World, which you all may know me from the name of, is just one of those members. There's a number across the country. 33 minutes. Number across the country. You might have heard a couple mentioned, like at the plenary there. It's Poder, Emma, Brett in Baltimore, all over the country. And the ones in red are actually full members. So they form the board and the council. The Working World, it was a progenitor for it. We live in Nicaragua, Argentina, and in New York. I'm not going to spend much time there. The last thing I want to draw your attention to, growth has been quite steady. We are an evergreen fund. We take in money consistently, constantly. We don't take in a fund, create a fund, and then assume people will get paid out. We pay on a rolling basis. So it has grown consistently. 84%, it's actually now up to 89% of the dollars that we have lent out have gone to people of color. So even if, you know, that would mean that if 30% of a business is people of color, then that will mean 30% of the dollars we lent, we'd count. If 80%, then 80%. And it's now up to about 90%. Actually, it's closer to, and that is one of our missions. One of our values are non-extractive finance, democratic ownership, sustainability, and radical inclusion. Radical inclusion means overcoming historical and systemic forms of exclusion. So I'll leave it off there. You know, there's wonderful, I could talk about our key sectors, places that we worked in. We are open to other sectors though. The way we believe in building good jobs over time with businesses, snapshots, I got other things, but I'll just leave it there as a pretty good intro we do. And we've been in this business for 15 years. We are a lender and an investor. Again, we have about over $15 million right now in our fund. We do deep technical assistance to accompany our equity-like. Even when we make loans, it's kind of like EQ2, it's equity-like loans. So I'll end there.
Brendan, thank you so much for the introduction to your work at the Working World and Seed Commons. I personally, I consider Brendan a godfather. Some would use the term OG, but definitely someone who I've looked up to in the space and who was really at really a vanguard and really at the spear's edge of bringing in these tools of finance, aggregating capital, and combining it with employee ownership and helping out communities of color. So thank you so much for the introduction. Really look forward to your answers to the questions. Next, I will pass it over to Jonathan Ward. Jonathan, go ahead and introduce yourself and tell a little bit more about Fund for Jobs Worth Owning, a little bit more about the ICA Group and your work there.
Great. Thanks, Todd. Yep, Jonathan Ward here at the ICA Group and the Fund for Jobs Worth Owning. We are a newer loan fund, so I'm looking forward to telling you, about us today. And it's great to be here with you. Thanks for all the Herculean challenges you had to, cross and having this conference. So the Fund for Jobs Worth Owning, ICA Group's been around for 40 years, helping to advance employee ownership. We work all across the country, but we're kind of new to this capital conversation. We have a loan fund now, and that's, in the past couple years made some big strides there. We've closed a couple loans, just starting to, build our pipeline and develop ourselves. So it's just so exciting to be here and participate in this type of conversation. The idea behind the loan fund and kind of our strategy is we really want to complement the existing co-op loan space, the CDFI space, and even the conventional banking space by offering a new type of loan product that's going to bring in more capital into it. So we talk about gap financing, mezzanine financing. That's that stuff you do when you need a higher risk percentage of the deal to come in, to be subordinated to the other group, to kind of act like equity or deferred payments. And we kind of believe if from the standpoint of working with conventional lenders, if we can be 5 or 20% of a deal, and tap into the billions of other dollars of capital that are out there, but provide some security. And ICA Group's experience and the fund's experience and employee ownership business underscored with that real flexible capital there, that's the way to scale by working with other loan funds to complete deals that otherwise wouldn't happen, and working with the conventional banking space to design credit products to attract them in and say, let's bring in your expertise in loaning in these different sectors and combine it with our expertise in running and developing employee-owned businesses, and here's how we back up our expertise and our partnership with you in this transaction. So thinking about it again as a complementary gap financing product to work in the existing capital and bring in new capital. The types of loans that we're trying to do, of course, conversions of existing businesses to worker ownership, innovative startups, also scale strategies for shared services and infrastructure for the cooperative space to build on. And while we work in, kind of all industries, broad development of employee ownership, our focus is really in home personal care businesses, caregiving businesses, and childcare. So home care and childcare is where we're really proactive in and want most of our lending activity to be. And of course, we're happy to be part of the solution and participate in a broad range of conversions and be part of that. A lot of those businesses in caregiving are owned by women, people of color, they're making up the backbone of our economy, so there's a lot of opportunity there and so much pressure, on childcare and home care in this pandemic reality that we have right now. Very different kinds of pressure, but pressure there. So we want to be there to support that. So thanks again for having the Fund for Jobs Worth Owning, be a part of this. And we're so happy to be here as well. So thanks for the opportunity.
Jonathan, thank you so much for being there. And speaking specifically of the ICA Group, again, organization has been around, I think you said 40 years now, creating employee ownership, really leading the field, and really excited about your role at the Fund for Jobs Worth Owning and all the work that you all are doing over there. Excellent, excellent. Look forward to your answer to the questions as well. It doesn't seem like Brett Jones from Evergreen is back on yet. We'll still keep an eye out for him. But we'll go ahead and pass it over to Phil Reeves of Dowie, Acres and Heritage Capital Partners, and the Legacy Fund, wearing a few hats.
Thanks, Todd. I really appreciate it. I echo the same comments that it's great to sit here with everybody. I think we love the hold of everyone's work, and this is the first time we've ever actually all got to sit down together. So I'm really excited about this conversation. And to Todd's point, I think we're kind of the new kids on the block, and so the Dowie A&H Legacy Fund effort is really designed to try and catalyze employee ownership and worker cooperatives and build on all the work that's been done before and try and push it to a new level. And so I'll share a few slides and maybe get some context about us a bit. Give me 1 second here. Can you guys see my screen?
Yeah, we can see it. Do present mode.
There you go.
There you go. Yep.
Perfect. So, I mean, I think what's unique about us is we're hyper focused on the wealth gap. And so the way we think about employee ownership is as a tool for racial equity. And so we're specifically targeting businesses that employ people of color and really Black and brown folks. And it's because of the fact that, you know, the gaps that have become so big and they're becoming even wider in this pandemic. So it used to sit that, you know, the wealth gap was about 10 times, you know, when you compare Black and white folks. And now that's gone just gangbusters. If you look at like the stock market or, you know, the 20 or 41% of Black owned businesses that closed during the pandemic. And so this is going to just keep exacerbating. And I think what the keynote highlighted so well was the idea that employee ownership and working cooperatives are a solution for the space. And I think that's sort of where we're sort of entering the picture is how do we take that momentum and use it to catalyze what the new economy can look like. And so for us, the industries that we're looking at are, you know, you see them here, very classic industries that employ a lot of Black and brown folks, landscaping, mechanical contractors, food processing. And we see just an enormous market out there of businesses that are large, that have scale, they're good companies. Ironically enough, in this pandemic, they're all essential businesses. And so, you know, it's a good time to sort of transition these firms to employee ownership. And so I think for us, the way we sort of think about it and go about it is, you know, we think a lot about what we call the operative. So our goal is sort of convert businesses to, I guess, the more formal ESOP structure. But democratic governance is sort of a pillar that we stand on, you know, as a part of DAWI. And so it's embedding democratic governance, agency, all of those ideals into a structure, and then simply using the tax benefits to sort of, you know, continue building a strong balance sheet, build resiliency in the company, and allow the company to have more cash to reinvest. And so I think, again, back to the idea of opportunity, there's, I mean, trillions of dollars of assets of baby boomers that need to sell their companies. That's becoming a massive problem today in the light of the pandemic. And we want to be there. And I think this is why I'm so excited about like just the field of practitioners in this space is because there's so much need there. I mean, there's owners who are not going to be able to exit another way, and that should be converting their businesses to employee ownership. And so that's sort of the space we're trying to play in. And then again, the impact we think of the work is huge. I mean, we all know this. I mean, this is literally me preaching to the choir. I'm sitting here talking to Brendan and Jonathan, but the idea is, you know, we all, you know, kind of put this forward as like an altruistic thing, but it's not. It's really good business. Like employee ownership firms outperform their peers. Retention's better. You know, when you take an organization chart and you know, it used to be like a CEO sort of leading everything, and then you flip it and you say, hey, the workers are the lead and everyone else is really just supporting them, you're going to build a better business and it's going to succeed. And I think the unique thing about this sort of structure and this time is that now that success, instead of accruing, you know, to the holders of capital and this, you know, these extractive investors, are now accruing to the workers. And for us, that's Black and brown workers who now for the first time are going to be able to save for college, invest in retirement, start a new company, you know, build their children up. I mean, it's just, it's huge. So I think I'll leave with this. This was sort of, again, we're new, we're in this sort of market now, but I think that the power of this model sort of highlights here, and I won't go into all the financial math, which I'll geek out on it, so I'll spare you guys. But the punchline is that there are opportunities to take. In this case, this was a trash hauler here in DC, 100 workers with $72,000 in their pockets. That's life-changing money, and that is closing the wealth gap. And so that at scale is sort of the vision that we see for the world. And so really excited for this conversation, and just excited to share more about it.
Phil, thank you so much. Again, as noted, Phil, I have the pleasure to work with Phil every day, sometimes depending on how the workload's going. At nighttime, in the evenings, we're on Zoom constantly, and I've known Phil since college. We went to Morehouse College together, and it's an honor to work with him every day. And again, he's my peer, he's my partner, but I look up to him in many ways. So Phil, thanks for being on today, and look forward to your responses to these questions. Again, unfortunately, we still don't have the opportunity to have Brett Jones on the line. It would have been, excellent to have him on as well. But I think the five of us, or the four organizations, we're going to find some more opportunities to work together. We're just getting into this and having a great time already. So let me go ahead and hop over to some of the questions that I'll pose. I'll start off with to get the conversation going. And while I'm talking, as other people have questions, feel free to send your questions in the chat to the moderator. And when it comes time for panel questions, we'll go ahead and flip over and ask those questions. So let me go ahead and kick us off. Jonathan, Brendan, Phil, feel free to jump in and answer in no particular order as you feel moved to. But the first question for today is, why is it important to utilize outside capital or investor capital to create employee-owned businesses? Why is it important to pull in this capital from outside of the organization or from the selling owner? Anybody, go ahead and jump in.
Call on us. Come on, man. Call on us. Call on us.
Go ahead, Brendan. Go ahead, Brendan.
We can switch it around, because why do we need outside capital? Because who owns the capital owns the capitalism, because we need resources. We have to get resources if we're going to overcome resource inequality. Just trying to pick ourselves up by our bootstraps to pool our money to create a cooperative is going to take over capitalism. Never. Their pile of money is growing faster than any of our savings ever could. As Avi pointed out in the plenary, if that's what it was called, the keynote, the thing, there was a couple $1 trillion that have been given to large finance in the last decade, many trillions. And that's, there's no savings we're ever going to do. So we need to get our hands on capitalism if we're going to tackle income and wealth inequality. So we try to be as radically inclusive as possible. It means people can't put up collateral. They can't, that's the point. If you're trying to work with people who need the opportunity, that means you can't ask them to put up the collateral, personal guarantees, et cetera. So someone needs to take that risk. I mean, a business is composed of the risk capital, equity, we usually call it, and then they can borrow against that and get its working capital and stuff. It's that risk capital that we're missing. You can't just say, great, we'll lend you money as soon as you have some collateral for it. Well, if our point is to overcome inequality, lending alone, well, we need to go past that. So we need to figure out a way to take that risk, but on behalf of the workers who are going to become the worker owners. So it's important to get that out, to raise a pool of people who will let you use their money for investment. I mean, you asked the next question, I won't get to it yet, but just a teaser, like, well, then what are the risks of doing that? Like, how do you, sure, are they going to let you take a risk with their money for the benefit of workers? And that's the next trick. But that's the starting point. That's why there's no other way we can scale anywhere near this to the solution, to the scale of the problem, unless we can bring in real dollars that then we can use for risk like venture. That's what I'd say.
Excellent. Thank you. Jonathan, Phil, anything to add to Brendan's statement?
I mean, the only thing I'll add is I think Brendan's making a great point. I mean, we spend a lot of time talking to current owners about conversions, and to make that conversion, you have to recognize the owner in some way, and that's hence the need for that outside risk capital. I mean, and it's particularly striking in industries where a lot of today's owners are, older people of color that employ people of color, and so, they've spent 20, 30, 50 years building these firms, and for them, like this was their retirement. And so they're kind of faced with two options. I can go and try to sell my business to some normal private equity firm that'll be really extractive, that might fire everyone, that might move my job out of the community. They can also just close. And we're trying to introduce a third option, which is, hey, you can also become employee owned. And to make that happen just requires that full capital stack that Brendan and Jonathan were describing in their opening remarks. And so we do need other capital. We need investors behind, like the folks on this panel, to help make those things come to fruition.
Jonathan, anything like that?
Yeah, I want to get to the next question. So it's speed, right? We can all just, build businesses organically, or we can try to, bring more money into the system and grow quicker and do. So, maybe that's the practical side. And, there's also the inclusive effect too, by extending capital to people who don't have the ability to put their own equity and such, and you can, be more equitable too.
Wonderful, wonderful. All right, so let's go ahead and keep moving through the question. So the next one is a question that may be on the mind of some of the guests on the call today. Doesn't using investor capital make the business investor owned instead of worker owned or employee owned? Like, how does it work? Isn't that why third party capital hasn't come in before, because we need these businesses to be employee owned? So if you all can talk through kind of that question or that concern that may be on folks' mind, and again, feel free, whoever would like to get us started. Don't be shy. Somebody go ahead.
I was going for Jonathan. I was waiting for Jonathan.
There we go. We could nominate each other.
So it seems like he wanted a chance to get to it. It only seems fair to.
Well, how gracious. This is good. I think it is a concern you have to be careful of. Whenever you have, money in the mix, as kind of Brandon and other folks are alluding to, there's power connected to that as well. And money can wield power, and money can force decisions and force an organization out of democracy, and, if the bank has 2 votes and the workers have 1 vote, we're not building the type of organization we're talking about here. If the bank's involved for 30 years in a transaction with, restrictive terms, it's going to be a problem for developing, I think, the culture of a business. But at the same time, when I get that question for borrowers, and in the space, it's like, well, having a loan from a bank, at least at that level, isn't really owning you, and there's owners of the businesses and then the creditors too, of course, right? And creditors are folks that, you ask for capital, because you don't have or, able to put in your own. And then the creditor says, all right, well, I'll kind of stay out of your hair as long as you meet my covenants, my requirements, paying me back on the schedule that we agree on, giving me the information that I want, and other things like that. And so, a lot of transactions that we do are, even if the owner's selling it or the bank is, it's like 100% of, the financing of the capital comes from financing. The buy-in fees are usually making a small amount. And so, these companies are highly leveraged, but they're definitely owned by their workers. And as long as they're continuing on and profitable and making their payments, I think we can feel good about using outside capital. But just be real careful of the terms. And, banks can start to act like equity partners, and equity partners can take over a business and say, oh, you have a lot of risk, well, I have more. And that comment perturbs co-ops and messes it all up. So, we need the capital, and we just need to be aware of the other side.
I mean, I think my take on this question is similar. And this is why, again, I'm so excited about the field of funds and investors in this space, because it matters who your capital partner is. And so, and the nuance that I think some folks recognize, it matters who your capital partners are. And so, like, we're very clear and very upfront with folks about, investing, at least with us, is, look, workers come first, trumps everything. And so we obviously, there's a great risk reward and a balance there, but you want capital from folks who get that and understand that. And so and it works. I don't want to give the impression that, like, we're asking people to make some kind of trade-off, like, because they don't need to. Like, again, I go back to that thesis of good jobs support good businesses, and employee ownership facilitates both of those things. And I think and really for all of us who are in kind of employee ownership, like lending and sort of investing space, I see it more as a temporary thing. I know in the way we structure, like, our opportunities is, look, we're only there temporarily, and then we're gone. And then this truly is a 100% deleveraged employee-owned business, and we're adamant about making sure that business keeps the idea of democratic governance going forward. And really, we're kind of using the time that we're involved to make it so. And so I think across the field, I don't think there's any. I'm running kind of through the list in my head now. I can't think of any sort of permanent capital where I think everyone else is, hey, we're here to facilitate a transaction, and then we're gone. And I think that's what you want to see.
Yeah, I'd say it's all like was just said. It's all the deal you cut. If you cut a deal where the bank doesn't have the ability to say, "Hey, we take more risks, so therefore we're going to take over." I mean, you have to be really careful about the covenants. I mean, I know plenty of like just plain vanilla entrepreneurs who all of a sudden find themselves taken over by their investor when they didn't realize, they didn't look at, oh, there was a benchmark that if I didn't, even though I worked so hard, et cetera, et cetera. Same can happen to a co-op, obviously. Which means for us, we have to remember who we're working for. We're a broker. We're in the business of matching capital and borrowers, not just directly though, and we work not to get the best return for investor, but to get the best capital for the borrower. Now, obviously, we can't do that if we just offer a terrible deal. Just like any broker, even if you're a seller's broker, you have to find a willing buyer, et cetera. So we have to work it out. But at the end of the day, we're going to do whatever we can for the worker. One way is like what Jonathan was saying is you have a bank, and if the bank doesn't take the wrong covenants, then you could be set. But what about the investors that we take? If we're placing the investment dollars, and it's all about the leverage that we can build. That's why it's really hard for a single co-op, unless they can get sort of philanthropic investment, to raise enough money to take that risk money. But a portfolio, becomes more possible, because when you look at the risk profile of a good diverse portfolio, I'd say if it's well managed and everything, it might not be as low as the market, or might not, or it might be really hard to measure. But at the very least, it can seem certainly less risky than a single business. So that helps a lot. That gives us leverage to say, hey, you don't have to take as high a return. We don't, even if you're going to take equity-like risk, you don't have to get equity-like returns, because actually over a portfolio, we have first loss covenants, it's going to look more like a fixed income to you. So we stand between the equity borrower and the fixed income lender to us. And that's, again, it's not as fixed as like the government bond is low risk, but that's our goal, is to try to do that. But still the question comes, if we're able to do that, and if we're able to say, look at what a great portfolio we put together, so we have some leverage, on whose behalf are we building that leverage? Is it to maximize the return to the investor? It will be if we actually work for the investor, no matter how nice our platitudes are. No matter what we say about being an impact, it'll eventually flow back to the workers. We have to know that we're doing it on behalf of the borrowers. So that's why we're really careful by not saying, yeah, we work for both sides, we're so sweet. We do have to work for both sides. Everyone has to be happy. We're not belligerent at all towards the people who put money in us, but we have to know that our goal is to maximize the benefit for the co-op we're investing in. It's like saying in the 1890s, well, if you take a job, it's a bad job. But of course, if you form a union and get leverage, it doesn't have to be a bad job. It depends on what you're coming to the table with and what kind of deal you can strike. If we can create leverage, then the investing dollars we can get might be at terms that work for co-ops. And the last thing I'll say on that, despite sort of the capitalists having all the power because they have all the capital, they have too much capital. They printed too much of it. There's so much capital out there. Now it all wants to get magic returns so that there's people out there who don't ever have to work. They just live off of the returns on their capital, but they don't know where to put it. And if you can get a reasonably attractive portfolio together, you can start to attract some of that capital. They need somewhere to put it.
Excellent. Thank you all for the answer to that question. So I'm going to shoot a little bit from the hip based off something Brendan, Jonathan, and Phil, I heard you all mention. And if you all could take a couple minutes and talk a little bit more about the role that your organizations play. You all help place the capital to make these conversions or these conversions to employee ownership happen. But what is the role of organizations such as yours in helping the company, which may previously have been, ruled by, one CEO or one owner who kind of made all the decisions? How do you help these companies transition from that style of work and governance and management over to something that is democratic and really starts to fulfill and live out, the purposes of co-ops and employee-owned enterprise? So that was a long question, but what's the role of your organizations in playing a training, a consulting, a growth, a cultural role within the organization? So I'll let you take it from there. Jonathan, you're the only one off mute right now, so I'll let you get started.
I got this little other thing I mute right there. It's cool. Yeah, so cool thing about the fund is, I mentioned the supporting organization of the ICA group, which has, been around for 40 years, providing technical assistance and training and consulting to organizations either want to become employee owned or existing, organizations that are trying to figure out what it means to be employee owned and have, value for the owners there. And I think, it works with our whole model of trying to mitigate the fund's own risk by, saying we want a TA partner, whether it's the ICA group or, or somebody else helping that business through the process. So, I don't think that approach is that uncommon. A lot of lenders are saying who your TA partner is and getting you through this journey is really key to my decision and, in wanting to support your financing. And, just because how we're organized with ICA, that's going to go hand in hand. We have home care and child care programs already, to start off. So there's a lot of just natural synergies that are both, I think, good for the companies and also good for our own, risk mitigation from the financial point.
Yes, similar. So, we're partnered with Dowie to do some of the same work around organizational development. I think, and Ty brings up the point that being employee owned on paper is not the same thing as being truly employee owned, and that cultural shift is hard. And so that's something that we take super seriously, and it's something that we're trying to institutionalize in a way that just creates longevity throughout the entire time that we're involved, and more importantly, post our own involvement. And that's everything from worker representation on the board, creating career paths, open book management, a variety of structures and practices to really give, again, that idea of agency and to the workforce.
Yeah, it's big. What's our role? Too much. As Melissa said, it's work. It's a lot of work to get this stuff done, but it's very important. And if you invest early, culture, it's really hard to change the culture of an organization. A conversion event is a moment when oh, hey, the gravity's turned off for a minute. You can rearrange things, and then there is a chance there because people realize there's something new that's happening. I got to say, crisis is as well. We were teaching some conversion classes in January, and someone asked, well, what was different about Argentina, where I worked for 7 years? And I said, there's not the cultural, everyone wants to assume there's some magical cultural phenomena in some part of the world, and I haven't seen that yet to do this. But we did say that the crisis meant a lot of difference. People were mostly like lifetime employment kind of folks, and they were willing to think very differently when there'd been a crisis. And I'm sure that people will now. So it's a chance for that cultural change. And I should also, we assume it maybe takes at least 2 years that we work with them. We might have to do the conversion a lot faster, and we might have to hold the company because the owner might want to, the purchase, I should say. We might have to do the purchase part in a few months. And that might take a lot longer to build ownership culture. We understand that. We're going to take the time to build it. We're not going to assume like ownership culture is going to just magically be built on the same time frame that the current owner wants to get out. So we do take our time with it. But it's definitely worth doing. I should just mention also, it's not only men in blue collars who can do finance. Most of our team's actually women. I don't even a decision maker anymore, so I'm just a stumper at this point. I want to help people have fun, but if you look at the credit committee of Seed Commons, we have it's a very diverse staff, and there's the real finance decisions, and our financial guru in the background, Karen Haskins, does. She's the one who keeps track of the books and everything. So I'm a stumper, but don't let the makeup of the committee give the wrong impression.
Very good point.
Excellent. Thank you all. Thank you all for that. I'll add one thing as put it on a panelist hat, moderator / panelist. But one thing that I like and that I see in these emerging models that use a fund structure, whether it's for a certain term or whether it's a more evergreen, kind of meant to go on and last continuously, is that sometimes your outside investors, depending on who the capital is, sometimes they can be more patient than some of the capital that has helped move conversions in the past. They know that their capital is going to be tied up to some degree over 3, 5, 7, 10 years. And as Brendan was saying, because they have difficulty placing capital, sometimes they want you to hold on to their capital for a certain period of time. and to produce those returns over time. So I think one of the benefits in some of these more traditional finance models is that there is an expectation that as managers or as operators, that you are sitting with these businesses for multiple years, and that you are working actively within these businesses for multiple years, as opposed to just, hey, here's the capital, make the conversion, make the transition happen, and then you go away and do the next one. And so I think that's one place where some of these new models actually lend to some of the best practices of helping people grow into their role as employee owners, as opposed to just saying, you're an employee owner, have moderator hat back on. Thank you all for humoring me there for a moment. I'll jump over to the next question. And this one, and you all touched on it, the question of where does the outside capital come from? Who are the investors? We hear the word investors or outside capital a lot, and this kind of vague phantom out there that's putting money into these opportunities and these enterprises. But can you guys give us a little bit more detail about the type of capital and the type of investors that you all look for? What is their profile? What do they care about? Maybe even where does their money come from?
And
Phil?
to clarify, this is about capitalizing us, right?
Yeah.
Okay. So I can just quickly say, I'm going to be an attendee here for a moment because we're brand new and we got some seed capital and a couple, but we need these tips too. So we'll defer for a second. I'll get in where I can.
And don't be afraid. Go ahead and if you want to shout out some of your seed capital, I know Candida, we give big ups always to city community development. So if you want to plug any of your capital, feel free.
Candida City, yep, essential.
So I mean, I'll jump in. So we're early, so we're sort of in the fundraising mode now, and I think it's been a fascinating experience. First time fund manager, emerging fund manager of color, all of that is fascinating to sit in the seat. And I think the thing that I've realized is, and I think Brendan said it well, like there's a lot of capital out there, and I think what's interesting is that it's starting to realize that it needs to be put to better use. And so you're seeing like family offices, which is exactly what it sounds like, some super wealthy family that just has a boatload of money thinking to themselves, hey, we've accrued all this wealth, but we want to see this vision of the world. How do we invest in a way that aligns with that vision? And you're same thing with like the foundation and philanthropic world. I think I'll harp on, be on this point for a second. I think the philanthropic community and they play such an important role for these types of efforts on a few fronts. One is standing up these organizations takes resources that are often hard to come by. And then, it takes a lot of work to, source these transactions, put them together. And like we talked about, spending time with them doing TA, and that philanthropic world sort of allows that, facilitates that. And the same way, it provides sort of the foundation of this, this sort of capital stack. I hate when we mix up terms here, but like our own capital stack, it gives other investors comfort and allows folks to test ideas and to prove a thesis and to validate that, co-ops in this, in this geography or in this sector work. And so it's just, I think the role of philanthropy in this space, we're still in the infancy stage. And so I don't want to give the impression that like, pension funds and university endowments and all these traditional massive capital allocators are in this space today. And I think we all want to see the day come when they are. I think today it's really leaning on the foundational folks, the people that get it, the aligned investors. You're seeing a lot of work in the CDFI space. I mean, like that's where it is today. And I think, and then on the fringes, there's these, wealth managers here and there, family offices here and there, and these early sort of impact funds. But that's sort of where I think the capital is, my own estimation.
Yeah, I'll not too much onto that. I'll just say, and despite what I said about there is too much capital out there, it doesn't mean it's easy to get. The people who have it don't give it up easy. And we're never we don't have access to the Fed discount window. We will never be bailed out. We will never be quantitative eased out, et cetera. So our track record can't ever, we're not going to get what they know they can get out there on the public markets. So it's definitely still dependent on philanthropic dollars or people with some interest in impact, which is hence the name of this panel. But there's more and more interest in impact, and there's more and more people looking like, where can I put my money? Again, if you can, it's going to have to be a mix of, the being able to offer a reasonable product, and with a reasonable return or reasonably low risk or some combination of both. But then it's going to take that impact, so you're not just compared to the market, because there's, why not just put your money in Vanguard then, be it billions of dollars size fund. It's got to be some interest in the impact. And also to do the operations, like what Philip was saying, it's for a while at least that we assume that we have to be a big enough fund before it can really cover this all that we have to do in order to prove it out. So it's not the same as grants. The money can get bigger than grants if you really get there, but it does take that impact lens.
Thank you all. One thing I'd like to add, and I guess almost another question is who should the investors be? And again, we gave the shout out to the Candidas, the cities, the Kellogg's, who helped seed a lot of the work in the field. But one thing we really, and Phil and I talk about this a lot, and I'm sure you all talk about it in the Working World ICA group, is how can we have conversations with traditional grant makers, foundations, about, going and doing if folks have heard of, PRI, program related investment, MRI, mission related investment, looking at how can you use grant funds to invest in the work that we're doing, but also looking at your endowment and seeing, and a lot more foundations are doing this now, looking at where their endowment, and that's the big pool of money they have, where they have to take 5% out a year and invest it in grants. Is your endowment aligned with the mission of your organization and with your foundation? And if it's not, can you look at your endowment and that money there as an opportunity to invest and align your corpus with your purpose and your mission by investing in organizations such as ours? So, who are the investors? Who should the investors be? It's a big question. We talk about something similar with pension funds. Is your state pension fund investing in something that's taking jobs out of the state? That's not alignment. That's how can we encourage them to put their money in places that's going to help preserve the jobs, help the communities that they want to help lift up and help close the wealth gaps that we see in the country today. Okay, moderator hat back on. Sorry, ate up a little bit too much time there. Let me see. I'm probably going to ask if we can probably do one, maybe two more questions. I want to turn it over to the audience. We're going to try to close out around 40 minutes after, or 45 after, so people can get to the next session. Let me see. Okay, so what are the risks? And we talked about it briefly, but what are some of the real risks of using investor capital in employee ownership transactions, and how do you mitigate against these risks? So this could be going into almost as detailed as how specifically do you invest plan to invest third-party capital in a way where it doesn't overtake, or it doesn't kind of ruin the mission or impact that you're trying to have. I know we kind of touched on it before, but see if you can get a little bit more granular.
I could just add a little, so that, as I did talk about it a lot of what the risks could be. I say just adding to the risk, don't count on the benevolence of even benevolent investors. We were working with, Sovereign Wealth Fund that said you should put money into green energy. It was cooperative solar stuff. Guy manager, they're like, we're never going to spend all this money. We think the planet should survive. Like, it couldn't be more of a mission they had. And then as they're putting together the deal, and there's community actors, the investors kept like, but are you sure? After we're already done, we're following. Can't the community cover the uplink charge? Can't they cover? And it's like, before you know it, the community is going to have zero money left over there. They saw money on the table. They're like, and they couldn't help but use their leverage. And these were nice people. Honestly believe that, ish, in the world. So, but it's so again, don't just, even if you make a great relationship, you've got to keep the terms, be really careful of the terms. Don't count on their benevolence, because they've got a job. They're used to their fiduciary responsibility, which is to maximize returns. But I think mostly it's to that leverage point. Know what your leverage is. Know where you can be friendly and where you have to draw the line.
Phil, I know a little bit earlier you used the term impact investors. We've been having lots of conversation with impact investors, and you gave the little, asterisk, bunny ears around impact investors. Can you talk a little bit about some of the experience with
Sure,
that?
sure. I think
the things that can push, possibly push us towards.
And I think Brendan's story illustrates the point, which is, and this is why I go back to again, who your investors are matters, and who you partner with kind of matters, and that's for us and for the folks we're working with. And I use the air quotes because I think it's I like others. I think it's funny sometimes when folks are like, "Oh, we're an impact investor," and then like what they're really saying is we want market rate returns, like super, like maybe even above market rate returns, and impact. And it's sort of like I think that kind of breaks the definition of impact, right? Like if you're otherwise that would be a market rate investment. And so I'm excited by the fact that this is why I love the sort of employee ownership cooperative space. I think that's where those two worlds can merge. And there can be, and this is why I love Jonathan and Brendan's work so much, this idea of proper risk adjusted returns, which is like, no. As you, the investor, are getting the proper return for the risk you're taking. And to Brendan's point around portfolio, and Jonathan's, the way they lend in the capital stack, because of where we're lending or the way we structure our portfolio, that risk is lowered. And so again, that idea of you as an investor being recognized works. And then I think anyone in this space, every single investment is an impact investment. And so that's what makes it so fascinating to me.
Excellent.
I never knew that was a running joke in in this space, how when impact investors come up, it's like the mythical unicorn of the impact investor, the one who actually will take a below market return for the impact. And I heard it the other day on some other venture capital. Todd might have been there too, and they're just like, oh, they don't really exist. And but maybe they will, and as the sea changes, and that could be an interesting story to write. The mythical creature becomes real, and that makes a big difference. So I just, that's a joke that I'm getting new to. I think the thing I'd add, maybe a risk is that the capital that funds have in this room is risk loving, supportive, kind of mission oriented capital. I think we don't want to run out of this, and so the question that we're looking at is how do you then use this to get into the other stuff, to use it. And that's a little bit of the funds concept. How can we do 5 or 10% of the transaction and you do the majority, of the transaction too? Which is mitigating, I think, risk for our space. So turning it a little different.
No, I think so. And I think this is where the idea for us is a few points. One, that's why I think it's important that funds in this space work together. Like we've talked to, I won't call it banks like Wake, we talked to Working Well, like it matters that we know each other, because again, it is that sort of full capital stack. I think again, I kind of go back to that point that there is an alignment, we believe, through proper risk-adjusted returns and employee ownership and sort of all the work that everyone in this field is doing. And I think it's important, and that's important because for this work to scale, that kind of has to be so. We have to find a way to do, people would put air quotes around this now, but to do good while doing well. And so what that means is proving out sort of all of our theses and validating the fact that when cooperatives are done right, and when other forms of employee ownership are done right, not only do they create massive impact for the workers, and for us that's like closing the wealth gap, they also are phenomenal businesses that will yield sort of the traditional ideas of success: growth, profits, cash flows, yields. And when I put my sort of investor hat on, that's what I'm looking for. And that marriage, I think that marriage is coming. I think that marriage is there. And I think that one day this sort of conversation we're having now will be like an asset class. That's at least our vision for the future. And I know, that's the work that, we're pushing towards, you guys pushing towards, Dow is pushing towards, that's sort of the scale. And that's sort of what I think the keynote touched on before was, if we're going to create a whole new world, we've got to sort of get all of these efforts, like just capitalize in a real way.
Excellent. Thank you all so much. I mean, this has been awesome. This has been amazing. We're going to go ahead and flip off of my moderator / panelist interventions, and we're going to go and flip it over to the audience. I know folks have been sending their questions over to the moderator. So if our moderator, I believe it's Chev, if there are questions that you'd like to pull from the crowd and ask, go right ahead. And in our remaining probably about remaining 12 minutes, we'll try to get as much of those questions answered. And everybody on the panel, no need to respond to every question. Let's see how many we can move through in the next 12 minutes.
Excellent. We have some great questions from the audience. I'll lump them together. So I'll have like 3 blocks of questions, okay? First is, what's the best way for unaccredited investors to put money into y'all funds? And in addition, people are curious about how small or micro investors can invest in cooperatives. And in line in that same questioning, folks would also like you to speak to potential limitations around crowdsourcing, if that's an option for raising funds for cooperatives.
Thank you so much, Chef. We got some folks who want to get involved. They want to be enrolled in the work. So any of our panelists, feel free to share. Anyone? We got investors on the line, folks. We got investors on the line who want to get involved.
Security, the SEC calling.
Yeah.
The discussion of investment opportunities is a bit of a legal bind. So, Jonathan, you want to go?
Thanks. That's generous. I think just to validate that it's on our minds, too, this, and it's not the first time. There was a transaction the other day that, was like, can we, put up the equity side by investing from the community? And so that, as a complement to the buy-ins of the workers for it. And so, I think the regulations are changing on this, but, loan funds are good about saying, oh, you don't have equity, can you raise some up for friends or family from your community? So I think there are structures out there to do it. I'm still pretty new to that. We're talking about it. We haven't closed something like that, but this stuff is right around the corner. So we're thinking about it too. And hey, validation that we're ready to go on this call. So extra to make it work now.
Excellent answer. I think all of our panelists get the joke. You have to be very careful. There are a lot of rules and regulations out there about talking about investment opportunities and pitching the folk broadly and widely. Some of that legislation has loosened up over the past few years, but most of us are very, very careful about it. I think the one space where there has been openings for folks who are unaccredited to invest is in the crowdfunding space, which has been developing more and more over time. And I know there have been some efforts for folks in the employee ownership community, the platform co-op world, to really start to utilize and leverage crowdfunding as a tool to invest in these opportunities. I don't believe anybody we're talking to on the panel today necessarily has anything connected up to crowdfunding in that way. So, and we'll leave it at that. We'll leave it at that. And again, that's not for lack of desire or want. A lot of that is the rules out there really limit who can move capital, how they move capital, and through what mechanisms and means that they can move capital. So
options. If you want to ask, you can reach out. You can reach out. Oh, did someone ask us? Well, you could reach out and talk. There are exemptions for non-accredited investors. So reach out.
Great. The next question is around due diligence. How does this differ from your practice in particular? How does it differ from traditional VC or PE investments? And can you talk a little bit about the difference or similarity between risk and volatility in your consideration for investment?
I'm sorry.
I missed the last part.
Yeah, me too. Could you just repeat that?
Sure. So it's about due diligence and how do you consider risk and volatility as you consider your investments?
Judiciously.
Very. And so happy to kick off. I mean, I think we take due diligence very super seriously is an understatement. We're looking at everything because we're trying to steward a business for the benefit of the workers. And so what we don't want to do, the worst thing possible, is to have a bad business get transferred to a bunch of Black and brown workers. And so for us, you know, a lot of the work is very similar to how a normal bank or a normal private equity firm may look at something. I think the difference is the fact that in addition to sort of looking at how we think the business can perform, we're also asking ourselves some questions that I don't think other private firms are asking. One is, if the business performs in such a way, how will that impact the workforce? And then we're asking ourselves questions like, you know, a lot of folks talk about like their value creation plan, and our value creation plan relies upon the workforce. So how are we planning to create value in this business? And what does that really mean? You know, what does our TA need to look like specific for this business and this geography and this industry? And so all of those sort of considerations sort of go into it. But I think I don't want to, I mean, it's still a very rigorous, thoughtful, intense investment committee kind of process.
Excellent. One thing I'll add is, especially when you're looking at the field of conversions, which is taking businesses that have been in existence already and converting them over to employee ownership. Sometimes we're dealing with businesses that have been, you know, generating cash flows and profit for 30 years, right? So for 30 years, so to say that this business model, you can look at the business model, and when you do your due diligence, you see that the founder has created with their team of management and workers a business model that works where it is, and that could possibly grow, or depending on the industry, could shrink. But when you think about it, it's not the same level of risk as like startup. This is not startup risk. It's not something that's never been proven, never generated cash flows. You know, a lot of the businesses that we look at are generating $1 million in cash flow a year. And our question is, how can we move that cash flow from one individual over to a group of workers? So, you know, think about risk and return in respects to businesses that have been around for a significant amount of time. So.
And I could say one other interesting, you know, thing on top of that too. You know, one of the due diligence, I think, is extra hard in co-ops because you're both underwriting the business, you know, and then a conversion, the new management structure, the governance, the culture, you know, and that whole thing. And so, you know, it's extra for it all. One of the things we do in home care and childcare to like cut through that a little bit and make it a little more understandable when we work with other banks is try to work with companies with recognizable revenue streams, public revenue streams. You know, a bank understands, hey, this company gets, you know, Medicaid dollars, you know, in this quantity each month, and they're a co-op. And then it's like, we can go talk about the co-op right away because you get the Medicaid, you get the Head Start and that type of thing. So I think that's, you know, be strategic about it. You know, it's going to be hard to talk to other banks, you know, about, you know, you got to win. This company as a construction company has to win every single job. It's a brand new culture. And then, you know, there's so many more questions than saying, you know, we get these revenues, you know, in a recurring way. It's normal. You understand it. And so I think, you know, you can pick and choose to make due diligence a little bit easier, but it always feels intense.
Yeah, there's no magic answer. Again, it's work. Spell it any way you want to spell it. But there are a couple of advantages. You know, one is we're not looking for the kind of returns that private equity is looking for necessarily. Looking for moonshots. They're looking for something that they can roll up into a large multinational, that kind of thing. You know, I know people who take over companies and they're looking to get 10x what they paid for it. As Todd put it, we're looking to keep a company going forward. You know, it's like, hey, if it had these earnings, as long as we can just steward that over and not lose, you know, it's like a relay race. Just keep that baton going. Hey, we won. You don't win at that point in private equity. You don't win by keeping it where it's at. So that's an advantage we have. Our goal is continuity, not like moonshots. So you also don't need it to be industries where everything is going through so much exciting change. It can be a nice, like you had a waste hauling business, you know, it can be an industry like you're not expecting, you probably, you know, some new, it's going to suddenly return 10 times the profit it used to because of a new technology. And that's good. You don't need to compete with private equity in that world. the other thing about diligence, I mean, then again, though, just because it's been working for a while doesn't mean it's gonna, like, boy, in the early 2000s, I would have loved to have sold you, like, some rotary phone business right before the mobile. I know the people who made the flip video camera, and they were bought by Cisco for like tens of millions of dollars. And then a month later, Apple introduced the first video feature on their iPhone. Cisco just closed it down after a while. They did not make a good bet, to the tune of, I'm like, we will never lose as much money as Cisco lost on that one. So that always puts me to bed okay tonight. But there's still the point of, like, you work for the workers doesn't mean you're like, great, so let's just get as much cash as possible. As I think it was Philip who put it, if you give a business over to people who you think, we're trying to overcome, like, inequality and the racial wealth gap by giving this business, and then it doesn't work, like, that is not a gift at all. It's the worst thing in the world. I mean, if that business doesn't work, a couple of rich investors lost some loose change, but a couple of people who needs lost a couple of years of their lives. And I've seen that. We've made loans that weren't good at times, and it still sits with me as a moral compass. And it feels just like getting that money is a gift. Productive assets are no fun if they're not produced insolvently. Like, then it's not fun to have a factory if it's like if it's a cost burden. So you really you have the motivation if you want to make sure it's solvent, even though you sit on the side, and that's something we convince our people who put money into us. So we've got to do real diligence. We got to make sure we actually believe it's going to work out on the other side.
Excellent, excellent. Thank you all so much. You know what? I'm going to flip it over, and we're going to give some instructions about transitioning over to the next sessions. However, I'd like to give each of you 20 seconds, close out and say whatever you want to say, related or unrelated to this panel, to all of the participants on the line. I'll give you 20 seconds, and then we're going to flip it over to prepare for the next sessions. Let's go. Once again, we'll go Brendan, Jonathan, Phil.
Okay. This is like the end of the debates, like Bernie Sanders, let's make socialism. I don't know. Let's make fucking socialism. We got to raise a lot of capital to do this, and you can't do it by being afraid. We can't be afraid of capital. That's like being in feudalism, being afraid of taking over the land that's owned by the feudal lords. Like, we got to take over the capital that's owned by the capitalists. There's no way to do that by getting our hands dirty in this. And the other thing I'd say is, I want to say one last thing. You said, who should be the investors? Well, ultimately, I mean, the public should be. I think we had some public folks here. Avi mentioned, and Avi and Naomi both mentioned the plenary, trillions of dollars went in from public coffers, went into private hands. That could be the workers' hands. That could be for the hands of the workers who are going to buy out all the silver tsunami businesses that are closing. That money exists. I said, like, we can't count on just the private markets. We can use impact investors and foundations to blaze a path that hopefully public policy, the same way it did for home ownership in the 30s, would do for worker ownership in the 2020s.
Jonathan.
Great. Well, thanks again just for the opportunity to be here today. We're still getting up and running, icagroup.org/jobsworthowning. And, it's just good to be part of this conversation. Yeah, let's go do it for democracy. Remember how we need to work together, and where all the other money is, and creative ways to go get access to that. So thanks for the opportunity.
Phil.
Same. Really appreciate the time. Really appreciate everyone joining. I'm super excited about the field. I think the thing I would leave with is where Brendan and John picked up. This is we are living in the middle of history right now. People write history books about 2020 and 2021 in these times, and I think it's on us to take the time to think big, to have vision, and to go after it in a real way. And so, really excited for the work everyone's doing here and the work that is happening all across the entire cooperative sector throughout the world.
Panelists, thank you all so much for being with us today. Participants, thank you for being on the line. I'm going to pass it over to our host, who's going to give a few instructions. I want you all to know that slides and panel contact info will be emailed out in a follow-up email. I see we're getting a lot of questions like that, so we'll definitely share the information with everybody on the day. Daniel, thank you so much, and I'll pass it back over to you.
Yeah, thank you, Todd. Really appreciate all of your amazing organizing work putting this together. Thank you again to Phil, Brendan, and Jonathan for participating. I also want to throw a shout out to Chev and Maddie, our staff support folks. Speaking of our staff support folks, they have put into the chat some updated information now that we have figured out all of our tech problems. So our second session block is going to be starting at 5 p.m. Eastern Time, 4 p.m. Central, and 2 p.m. Pacific Time. So that's in just about 20 minutes. The sessions will still go for an hour long. You can find the new links either by looking in your email, either by looking at our Slack. We've also just posted them in the chat as well. So there's 3 different ways for you to be able to access those updated links. You can also probably check out our website as well for more just general information on how we're dealing with all of the tech that's been going on. But thank you again, folks, for your patience. This is our first huge digital event like this. It's so expansive, but I'm really just moved at how successful it's gone so far. So thank you all so much, and have a great rest of your day, everyone. Good to see you all. Bye-bye, folks.
Bye, everyone.